Germany's 1% rule for company cars. Why a cheap used luxury car can become a tax trap. Part 1. Many entrepreneurs and self-employed people in Germany use a company car. At first, this sounds simple. The company buys or leases the vehicle, pays for insurance, repairs, fuel or electricity, and the car is used for business appointments. However, things become more complicated when the company car is also used privately. In that case, the German tax office treats the private use of the car as a personal benefit. In German tax language, this is called a geldwerter Vorteil, which means a benefit in kind or a non-cash benefit. This benefit is taxable. For many foreign entrepreneurs in Germany, this rule is difficult to understand. In many countries, people would expect the tax calculation to be based on the actual purchase price or current market value of the car. In Germany, however, the so-called 1% rule follows a different logic. The most important point is, under the German 1% rule, the tax calculation is generally based on the original gross list price of the car when it was new, not on the actual purchase price. Logbook or 1% rule. If a company car is also used privately, there are usually two ways to calculate the taxable private use. The first option is to keep a logbook. This means that every trip must be recorded. Date, mileage, destination, purpose of the trip, and whether the trip was business-related or private. In theory, this is accurate. In practice, it is often annoying and time-consuming. Business owners are constantly on the road, meeting clients, visiting suppliers, going to appointments, and sometimes combining business and private matters in one day. Nevertheless, the German tax office wants a clear separation between business use and private use. The second option is the 1% rule. Under this method, you do not have to record every private trip. Instead, 1% of the original gross list price of the car is treated as a taxable private benefit every month. This makes administration easier, but it can become expensive, especially with used luxury cars. The biggest misunderstanding: the purchase price does not matter. Many business owners think, I bought this car used for only 15,000 euros, so the tax should also be based on 15,000 euros. Unfortunately, that is not how the German 1% rule works. The relevant amount is generally the original German gross list price at the time of first registration. This includes VAT and special equipment. Even more importantly, this also applies to used cars. So even if the company buys the car very cheaply as a used vehicle, the tax calculation may still be based on the original new car list price. This is where many foreign entrepreneurs are surprised. Example: a used Porsche bought for 15,000 euros. Let us take a simple example. A company buys a 10-year-old Porsche for 15,000 euros. However, when the car was new, its original gross list price was 150,000 euros. For the 1% rule, the tax office does not use the purchase price of 15,000 euros. Instead, it uses the original list price of 150,000 euros. The calculation is 150,000 euros times 1% equals 1,500 euros per month. These 1,500 euros are not paid out to the user of the car. The person does not receive 1,500 euros in cash every month. But for tax purposes, it is treated as if the person received an additional monthly benefit worth 1,500 euros. If we assume a personal tax rate of 25%, the additional tax would be approximately 1,500 euros times 25% equals 375 euros additional tax per month. Over 1 year, this means approximately 18,000 euro taxable benefit times 25% equals 4,500 euros additional tax per year. Depending on the individual case, solidarity surcharge, church tax, or social security contributions may also increase the total burden. In other words, even though the car was purchased for only 15,000 euros, the private use of the vehicle may create several thousand euros of additional tax every year. Why foreign entrepreneurs in Germany should be careful. Many foreign business owners are not familiar with this German tax logic. In many countries, it would seem natural to use the actual purchase price or current market value of the car. But under the German 1% rule, the original new car list price is decisive. This can be especially problematic with older luxury cars. Examples include Porsche, Mercedes S-Class, BMW 7 Series, Audi A8, Range Rover, and other high-end vehicles. These cars often lose a lot of value over time. After several years, they may appear affordable on the used car market. But their original list price was often very high. And exactly this high original list price can become the basis for the German 1% rule. For older luxury cars, private ownership may be the better option. If an older luxury car is available at a low used car price, it is especially important to check the tax consequences before buying it through the company. If the current purchase price is low but the original list price was very high, it may often be more tax efficient to buy the vehicle privately instead of through the business. In that case, the entrepreneur may be able to document business trips separately and claim business mileage or travel expenses, depending on the situation. This avoids the problem of having the high original list price used every month for the 1% rule. A simple rule of thumb is, the lower the current used car price compared to the original new car list price, the more carefully you should check whether the 1% rule makes sense. Or more simply, an old luxury car is often better kept as a private car rather than a company car. Of course, this depends on the individual case. Business use, private use, company structure, income level, and actual vehicle costs must all be considered. The 1% rule is not only for petrol cars. Some people think the 1% rule only applies to petrol cars. In practice, it generally applies to normal combustion engine vehicles, including diesel cars, unless special tax benefits apply. For fully electric cars and certain plug-in hybrid vehicles, more favorable rules may apply. Electric cars, 0.25% instead of 1%. Fully electric company cars can receive significant tax benefits in Germany. Under certain conditions, the private use of a fully electric company car is not taxed at 1%, but at only 0.25% of the gross list price. Example, a fully electric company car has a gross list price of €80,000. For a normal combustion engine car, the monthly taxable benefit would be €80,000 times 1% equals €800 per month. For a qualifying electric car under the 0.25% rule, the calculation would be €80,000 times 0.25% equals €200 per month. If we again assume a 25% personal tax rate, the additional tax would be approximately €200 times 25% equals €50 per month. That is a major difference. Currently, fully electric vehicles with a gross list price of up to €100,000 may qualify for the 0.25% rule under certain conditions. However, the exact treatment depends on the acquisition date and the specific vehicle. Plug-in hybrid cars, 0.5%, but only under certain conditions. Plug-in hybrid vehicles may qualify for the 0.5% rule. However, not every hybrid car automatically receives this benefit. The vehicle must generally be externally chargeable and must meet certain environmental requirements. Important factors include CO2 emissions and electric-only driving range. For vehicles acquired from 2025 onward, an electric-only range of at least 80 kilometers is an important threshold. Alternatively, low CO2 emissions may also be relevant. A normal hybrid or mild hybrid without external charging usually does not qualify for this benefit. Therefore, before choosing a plug-in hybrid as a company car, it is important to check the technical data, registration documents, CO2 emissions, electric range, and acquisition date. Commuting between home and work may create additional tax. Many people forget another important point. The 1% rule covers general private use of the company car. If the vehicle is also used for trips between home and the workplace or business premises, an additional taxable benefit may arise. In many cases, this is calculated at 0.03% of the gross list price per kilometer of distance per month. So if the original list price is high and the distance between home and work is long, the tax burden can increase even further. When a logbook may be better. Keeping a logbook is inconvenient, but it can sometimes be the better option. This may be the case if the original list price of the car is very high. The car was bought used at a low price. The private use is relatively low, or the car is an older luxury vehicle. With a proper logbook, taxation is based on the actual private use share and the actual vehicle costs. This can be cheaper than the 1% rule. However, a logbook must be accurate, complete, and kept on time. A logbook created later or containing mistakes may be rejected by the German tax office. What to check before buying a company car? Before buying or leasing a company car in Germany, you should not only look at the purchase price. You should check the original gross list price, the special equipment included at first registration, whether the vehicle will be used privately, the distance between home and workplace, the legal structure of the business, the personal tax rate of the user, and whether the vehicle is a combustion engine car, electric car, or plug-in hybrid. For used luxury cars, it is especially important to calculate the tax consequences before buying the car through the company. A car may look cheap on the used car market, but under German tax rules, it can still be treated like an expensive luxury vehicle. Conclusion: a cheap used car can be expensive for tax purposes. The German 1% rule is convenient because it avoids the need to keep a detailed logbook. But it is not always the cheapest option. This is especially true for older luxury cars bought at a low used car price. The key rule is, under the 1% rule, the actual purchase price is not decisive. The original gross list price of the car is decisive. A used Porsche purchased for €15,000 may still be taxed based on an original list price of €150,000. This could result in a taxable benefit of €1,500 per month. With an assumed personal tax rate of 25%, this may create approximately €375 of additional tax per month, around €4,500 per year. Foreign entrepreneurs and self-employed people in Germany should understand this rule before buying a company car. A cheap used luxury car can quickly become a tax trap. In many cases, it may be better to buy an older luxury vehicle privately and claim business mileage separately, instead of placing the car in the company. Disclaimer: this article provides general information only and does not replace individual tax advice. The actual tax treatment depends on the specific vehicle, acquisition date, business structure, private use share, personal tax rate, and other individual circumstances.